Welcome to another Stone and McCarthy video. This particular video deals with Fed policy and the monetary transmission mechanism, particularly the portfolio balance channel that Chairman Bernanke and others at the Fed have talked about. What we're going to do today is we're going to kick off a series of 3 commentaries and 3 videos, hopefully, that will address what the Fed has done and what they're likely to do. This one will deal with the nature of the portfolio balance channel and what the Fed has done. Assisting me in this analysis is Doug Brain from Stone and McCarthy. Doug did much of the data work, and what we're talking about here today would not be possible without his efforts. So thank you, Doug. The portfolio balance channel basically is the concept that the Fed, by intervening in the market and lifting securities from the marketplace, is changing private sector portfolios in a way that will require them to rebalance those portfolios. And the rebalancing of those portfolios will mean they will substitute securities like corporates or mortgages for the treasuries that the Fed has acquired with similar risk attributes. They might not have the exact same duration or interest rate risk, but they might have other interest rate risks, such as liquidity risk or default risk, or so forth and so on. And by doing this, it's encouraging lower private borrowing costs, and presumably that will give a boost to aggregate demand. So the Fed has taken 3 steps so far. The first was LSAP 1, or what we call QE1. The second is LSAP 2, or QE2. And the third is the Maturity Extension Program, which is currently underway and will continue till the end of June, and this by the marketplace is usually called Operation Twist. So these are the 3 things that the Fed has done. LSAP 1 began in March as it related to the Treasury's buying of the Fed's buying of Treasury securities. Began in March of 2009 and extended until October of 2009. This was a $300 billion package. It took the Fed's holdings of Treasury securities from 7.8% of marketable securities up to 11%. Now, if we look at all these programs together, the Fed now holds about 16% of all marketable Treasury securities. But more important than that is the particular securities they own. In LSAP 1, they bought securities that had an average maturity of around 7 years. And if we think about the duration they took out of the market, the Fed's portfolio had a duration of about 57.8 months, up from 56.8 when they started. So they took out about 1 month of duration. And when we look at that in terms of the $300 billion of securities they acquired, the metric that's important here is the so-called 10-year equivalents. In other words, if they only bought 10 years, how many would they have to buy to remove the same volume of duration? And the calculation here is the $300 billion that they acquired was the equivalent of about $171 billion of 10 years. So if they bought $171 billion of 10 years, they would have removed the same interest rate risk out of the market as the $300 billion with an average maturity of about 7 years. And LSAP 2, or QE2, which began in November of 2010 and extended through the end of June of 2011, the Fed picked up another $600 billion of Treasury securities with similar maturity structure to LSAP 1 or QE1. The interesting thing here is that the Fed's duration of its portfolio expanded marginally by another 0.86 months to 58.15 months. The average maturity actually declined a little bit during that period of time to 76.86 months. But what's important here is the $600 billion of treasuries they acquired, in addition to the $182 billion of reinvestments that they made from the principal payments on mortgages and agencies. At that time, they were reinvesting them in treasury securities. Now they've been reinvesting them in mortgage-backed securities. But the total $782 billion of money, of treasuries they bought during that period, so again, $600 billion as part of the LSAP program, and another $182 billion as part of the reinvestment program. So $782 billion altogether was the equivalent of $434 billion of 10 years. So if they only bought 10 years and they bought $434 billion, they would have had, in theory, removed the same level of interest rate risk. Now, of that $434 billion, we can proportion it in a fashion similar to the securities they acquired, and about $334 billion of it was related to the LSAP program, and the other $100 billion was related to the reinvestment of principal payments for the mortgages and agencies. The maturity extension program, which was buying $400 billion of longer-term treasuries that had a remaining maturity of 6 years or longer, and selling $400 billion of shorter-term treasury securities that had a remaining maturity of in excess of 3 months, but up to 3 years of maturity. So in other words, they bought 400, they sold 400. The size of the portfolio was virtually unchanged. But this too had a measurable impact on the duration of the Fed's portfolio. In this case, it increased by 17.46 months to date. That goes all the way through May 9th, from 57.9 months to 75.34 months. The target as of the end of June is 84 months. I'm not sure they're actually going to reach that target. With regard to maturity, the program was to increase the average maturity of the Fed's portfolio from a little bit less than 75 months up to 100 months, and they've already exceeded that. As of May 9th, the average maturity of their portfolio was close to 102 months, and presumably it's going to go a little higher in the remaining weeks of the program. But even though the size of the Fed's portfolio was unchanged, the increase in duration of the Fed's portfolio had the impact of removing $269 billion worth of 10-year equivalents so far, and that will rise over the remaining time of the program. So it will come in close to what LSAP 2 did. In fact, the $600 billion associated with LSAP 2, as I mentioned, took out $333 billion or $334 billion of 10-year equivalents. This will be in the same ballpark. So the 10-year equivalent is an interesting metric to gauge what the Fed's doing, and that this will be important as we move forward. When the FOMC meets later this year, and if they decide to maintain an unchanged policy, we have to ask, what is an unchanged policy? And I would contend that an unchanged policy is maintaining in the Fed's portfolio a certain volume of 10-year equivalents.